Get in Arvind Sanger, Managing Partner of Geosphere Capital Management, who joins us right now on the show. Good to have you, Arvind. Thanks so much for joining in. Let's start off with what's the outlook on the markets post the GAAR and the FII tax implications, because the markets seem to have taken it slightly negatively. What's your view on GAAR?
I'm obviously quite concerned. I think all investors are quite concerned, given that the Indian market has been largely driven by FII flows in the last few months. If the government wants the market to come off because they have no interest in foreign capital coming in, then it's a great strategy. If on the other hand the Indian government needs foreign inflows to fill in the gap in the current account deficit, then I think the finance minister needs to come out with something more specific than just statements on television saying that they don't intend to go after FIs. We would need to see more specific language attached to this GAAR to give investors confidence that at some point in the future the tax authorities are not going to question either P notes or other Mauritius-rooted or Singapore-rooted investment strategies.
Arvind, hi, morning. The Q4 season is going to kickstart in 2 weeks from now. Do you think IT and auto companies could give a positive earnings surprise this time?
I think that the IT companies, people are underestimating some of the headwinds from the European financial industry slowdown and the effect that that could have on the IT companies. So therefore, I'm not so sure that there's likely to be a positive surprise. Yes, they've benefited a little bit from the recent weakening of the rupee, but there are more important factors than what the currency does in terms of business outlook for their customers. As far as the auto companies are concerned, I think the slowdown in auto sales that we saw last year has seen some recovery this in the last couple of months, but I don't have a strong view on whether that's going to result in positive surprises. Obviously, Tata Motors is a bit of an exception because it's it's driven by what happens to JLR, but the Indian auto industry in general, I think it may be an inline quarter, but I'm not expecting any big surprises.
What's the view, Arvind, on FMCG and cement stocks? They've held out pretty well.
Well, the FMCG companies are benefiting from the fact that that's kind of a safe haven where demand growth seems to be relatively visible, and some of the recent slowdown that we've seen caused by the RBI rate increases has not had an effect there. So I think that can still remain a safe haven. The cement companies clearly have shown, for whatever reason, some very strong and stable pricing power and have started to see demand recovery. So I think these two sectors remain somewhat protected from some of the slowdown concerns that exist, but the valuations are not cheap. So I think to the extent that people keep chasing winners, they could continue to work, but I think the risk is that these stocks are expensive, and if you get any sell-off, whether or not some profit booking might happen in these sectors too.
Your outlook on Indian oil exploration stocks, especially after the additional cess which has been imposed in the budget?
Well, the government has done a phenomenal job of making the Indian oil sector uninvestable for the most part. And certainly that's been true for the oil marketing companies, for ONGC and other subsidy bearers, because the tremendous uncertainty around what the subsidy burden is going to be and how it's going to be shared. The cess has clearly affected one of the companies, I guess, Cairn, which was maybe somewhat investable before, and now this added additional burden. I think in general, we with very few exceptions, we generally stay away from oil companies in India. We prefer to invest in companies where we can analyze the fundamentals and don't have to analyze government decision making as much as investing in Indian companies requires.
Do you see the government taking up the oil sector reforms anytime this year? And how do you see the government addressing the issue of rising oil subsidy, Arvind?
Well, I hope we get oil sector reforms in my lifetime. But this year, with this coalition, with this current situation, I think the reforms we may get might be the kind that we saw. We saw oil price supposedly decontrolled a few quarters ago, and then the oil marketing companies maybe every so often, maybe sometimes when they get clearance from the right authorities, the oil marketing companies, which are mostly controlled by the government, sometimes raise prices. But even that might be even that fake decontrol might be a step too far for the diesel. I think, given the current sensitivities of the coalition and what have you. I guess at this point, the best we can hope for, in my opinion, is maybe doing a price increase to at least reduce some of the subsidy burden that either the government or the oil companies or both will have to bear. But even raising prices one time, which is far from fixing the fundamental problem or doing any structural reform, even that looks like there's some coalition partners that are strongly opposed. So we'll see when it happens. But I'm certainly not banking on it at this point.
Arvind, what is your estimate of crude oil prices then in the light of the geopolitical situation in Middle East?
Yeah. So our oil prices are, currently in the Brent is currently in the 122, 123 level. We think that barring any shooting breaking out in the Middle East, oil would head towards $100. But given the fact that the embargo is going to start impacting Iranian oil exports over the next few days and weeks and months, we think oil remains let's say 110, 115 to 125, 130 range, while the disruption from Iran and the risk of an even more significant disruption remains. So that's kind of our range right now. But we think oil has a downward bias. We don't think it has an upward bias given the global supply-demand fundamentals.
Okay, Arvind, good to have you today on the show. Appreciate you taking the time out and joining us.